investment grade ratings are received by financially strong companies. Now, if you want to go the junk bond route, ratings are received by companies making payments that default risk is high. You'd be surprised some of the companies that are considered junk bonds, such as Sun, Burger King, Kodak, Ford, Hilton, Office Max, Goodyear. Of course, if you want the junk bond, you would require, again, a higher rate of return. If you're willing to accept that risk for that bond, then you might want to add a portion of your investment into junk bonds. Okay, yeah, split ratings occur when bond issuers is given different ratings by major agencies, such as a difference between Moody's and Standard & Poor's. Of course, higher rated bonds have less default risk, and of course, with that less default risk, the company or agency is going to pay a lower interest rate. And here's table 10.2 bond ratings. Here gives you an example of Moody's and Standard & Poor's. Above, let's see, this mark right here and above would be considered investment grade, and junk bond rating would be between with Moody's here B, little a, and B. And of course, you can see the C's, which I don't understand why anyone would want to invest in this type of bond unless you had some information that the company was going to turn around and be able to make good on their promise there of paying interest and principal. Hey, let's look at the market for debt securities. Just as stocks, you need liquidity. Secondary market makes it possible for you to buy and sell stocks. You can buy when it first when the company first comes out with a bond, or you can buy it in the secondary market. Just like the example I gave here, if you thought interest rates were going to go up in 2 years, you might just look for a bond that matures in 2 years, so you get the higher interest rate. 2 years after you think those interest rates are going to go up, the company would pay you the principal, which you could reinvest somewhere else. But bonds are traded mainly over the counter. You have a bond price actually is stable compared to stocks. Bond market is larger than the U.S. stock market. Of course, bond market is growing rapidly. See, 250 billion in 1950, 27 trillion in 2006. Twice the size as the U.S. stock market. So it's a good place. Another vehicle to earn some type of income that's not as risky as stocks, but it's going to give you that income that you're looking for from a CD or money market. And of course, you have a risk with those type of investments in the sense that they're paying a low interest rate right now. So, bonds may be the method you might want to use, or at least put some of your portfolio in this type of vehicle. Okay, let's look at some different types of bonds. Let's move to the government. First here, you have Treasury bonds. This is considered risk-free. No risk of default because it's the U.S. government that's issuing them. If they need more money, they can always tax you. Of course, they could always just print more money. Interest is exempt from state and local taxes, sold in $1,000 denomination. You have tax and treasury bonds. You have treasury notes, matures in 2 to 10 years. Treasury bills, 20 to 30. You have your Treasury inflation index, are called TIPS. If you think inflation is going to go up, these were first issued in 1997. And if you think inflation is going to go up, this might be the type of bond you would choose for your portfolio. Okay, if you're looking for a little more interest rate, you might decide to go with the agency bonds issued by the U.S. government agencies, such as the Federal Home Loan Bank, Federal National Mortgage Association, and Small Business Administration, Fannie Mae, those type of investments. These are high quality securities with almost no risk of default. But then again, especially in current times here, it's not an obligation of the U.S. government to bail these out, but up to this date they have. But I don't know if I'll agree with this almost no risk of default. Could be. Interest rates are usually higher than the Treasury issues, so it's just another way to earn more interest and take on a little more risk. Okay, another method of earning money, tax-free here. You could use municipal bonds. These are issued by the state, counties, cities, and other subdivisions of the government here. If you want to buy a bond, usually you have to come up with $5,000, or you could always pick a mutual fund. Now, living in Ohio here, if you picked an Ohio municipal bond or Ohio municipal bond fund, just a mutual fund, they would be federal income tax free and also state. You have your two basic types of bonds there. Your general obligation bonds are paid from the general funds of the issuer, and then you have revenue bonds are paid from the revenues from the project being financed. These are consist of about 70 to 75% of the new issue would be your revenue bonds. Often guaranteed by private insurance to lower the risk and interest rates. When I buy a bond, I look for highly rated municipal bond funds. I look for Ohio, so I don't have to pay any state income tax along with the federal. I also look and make sure it is insured. So I have a whole bunch of different avenues here to make sure that I'm going to be paid my interest and my principal. Okay, let's look at table 10 for your tax equivalent yields here for various tax exempts. Let's say you were in a 25% tax bracket. You could earn 5% on the municipal bond fund here. This would be an equivalent yield, so you'd have to go out in the market and find an investment that was earning 6.67% to match your in a 25% tax bracket to meet that type of 5% return here. If you move to 6, you can see it's 8%. As your tax bracket goes down, the benefit of the tax yield it lessens. The higher it is, the higher it goes up here. As you can see here, 35%. The 5% would be 7.69 compared to 6.67 for the 25% tax bracket. Okay, let's turn to corporate bonds here, issued by corporations on 4 major segments here. You have industry, public utilities, rail, transportation, financial issues, usually issued in a denomination of 1,000. Of course, this can provide a higher rate of return than government bonds due to their, of course, the higher risk of default. They can't print money or tax people. Wide variety of bonds, quality and bond types are available if you decide to invest in corporate bonds. Okay, let's turn to zero coupon bonds. Do not pay interest. Sold at deep discount from par value. Value decreases over time. Subject to a tremendous volatility because of interest rate. Interest rate must be reported as it is occurred for tax purposes. So the main disadvantage is even though you're not receiving any money, you still have to pay taxes on the accrued interest. Treasury strips are zero coupon bonds created by the U.S. government treasury, so you can also either go to a corporation or the U.S. government to buy these types of bonds. Okay, let's turn back to the government here. You have mortgage-backed security bonds backed by mortgages. Principal and interest are paid monthly. You have Fannie Mae, Ginnie Mae, all these. Minimum issue is $25,000 up to 30 years for maturity. Of course, if you'd like to invest in these and you don't have $25,000, you can always purchase a mutual fund. It's a self-liquidating investment since a portion of the principal is received each month. You have asset-backed securities issued by corporations and backed by pools of loans, Ohio loans, Ginnie Mae. You have the GMAC, Joan Motors there. You have credit card loans, home equity loans. Provide high yields, short maturity, so 3 to 5 years interest, and principals are monthly, and high credit quality for asset-backed securities. Turn to the junk bonds here. If you try to receive a higher return, you're speculating that these companies will pay their interest and their principal. You have high to low sub-investment grade ratings. You remember your B, little a, or B typically offer very high yields because of the high rate of default. Price tends to behave more like stocks than bonds. Just like with stocks, you have global bonds. When we're talking about investing, if you just look just for the United States, you could be missing out on potential higher interest rates overseas than U.S. bonds. Of course, we talk about diversification. It's always good to diversify your portfolio here, so adding dollar bonds would be a good way to do that. Interest rates trends in other countries may not follow the U.S. So, in a way, like I said, interest rates may be going down in other areas. Of course, you have the currency exchange rate fluctuations can impact returns in U.S. dollars, as we talked about with the stocks. Okay, if you want to take off the security or the currency type of risk, buy dollar-denominated bonds, bonds issued by foreign governments or corporations in the U.S. dollar here. Based on the U.S. dollar, you have Yankee bonds. They're registered with the SEC and they're issued and traded in the U.S. You have Euro dollar bonds, which are not registered with the SEC and are issued and traded outside the U.S. No currency exchange risk since bonds are issued in U.S. dollars. But then again, if we talk about the Euro dollar bonds, according to which country you buy it from, because they're having all types of problems now with the euro. Okay, with foreign paid bonds here, bonds issued by foreign governments or corporations based on currencies other than U.S. dollar. So you are subject to currency exchange risk. Not registered with the SEC and issued and traded outside the United States. You only have that option. Okay, now let's look at convertible securities. It's a fixed income security that allows the holder to convert the security into a specified number of shares of the issuing company stock. So if you like the company, but you're not for sure that you want to invest in that company, you like to have a higher interest rate than maybe they're paying a dividend, you might go with convertible. You have two types, convertible bonds, which is your most common type, and convertible preferred stock. Equity kicker, another name for the conversion feature that allows the holder to convert the security to a specified number of shares of common stock, or forced conversion, calling it the convertible bond by the issuing firm.